Meredith Whitney, CEO of Meredith Whitney Advisory Group. It is so great to welcome you back to the show. Great to see you again, Meredith. And it has been way too long. We are absolutely thrilled to have you on again.
Thanks so much. It was fun last time and it'll be fun this time.
I agree. I had a lot of fun too. And so I don't want us to have another year plus pass before we get you back on. So we'll try to do this more regularly. But Meredith, let's start where we always start, since it has been such a long time. And that's with more of that macro picture, where we are today, your outlook as it relates to the economy and markets, what you're paying attention to, the framework in which you're looking at the world. And as you know, Meredith, on this show, you can take all the time you need to set the table when it comes to that big picture macro view.
Okay, well, as you know well, I pay so much attention to the consumer. So the consumer data is really granular, and there's a lot of it. So what you see now, which is not clear in the hard numbers, is a very segregated consumer between the high end and Main Street consumer. And I think Main Street consumer, this is 52% of households, are about to go into their second recession, right? So there's been no technical recession for a very long time, but Main Street, 52% of households had big improvements in their after-tax earnings during COVID, when COVID stimulus increased their after-tax earnings by a factor of about 30+%. And so when that ended at the end of 22, September 22, their after-tax earnings declined by commensurate amount. So that was really the first recession they went through over the past few years. And I think the next one is upon us because you have cumulative inflation. I think inflation is about to tick up. I think the summer is going to be critical to watch prices increase dramatically and really sting households that are living paycheck to paycheck. So I think, and also if you look at incomes are most vulnerable in hospitality and leisure, and that's where I think you're going to see job losses, because you're seeing consumers really pare back in spending, and today's numbers were reflective of it. And I think you're going to start seeing job losses in those areas.
Got it. Okay, so many threads I would love to pull on with you. Are you expecting, did I hear you correctly, you're expecting a recession ahead?
I think that, so not a broad-based recession, but if you look at segments of of households, 52% of households, I think, went through a recession at the end of 2022, 2023. And I think they're headed into another recession caused by a new wave of inflation, and I think and job losses. So that's going to impact households that are earning below 70,000. That's 52% of all households, and living paycheck to paycheck. Now, the high end is doing incredibly well and spending. What is interesting is I think you're starting to see what I call the avocado toast generation, those between 24 and 38 getting a little squeezed and paring back on spending too. But broadly, I think that high-end consumer is holding up this economy.
Yeah. Okay, so that's an interesting point too. You point out 52% of households had gone through a recession. From what I see in the comment section, when I read notes from viewers, folks will say, I've been in a recession, I'm in a recession. And I think a lot of people intuit this, that there are these distortions happening because of, I guess, wealth effects and whatnot. And then I'm looking at, markets still almost like reaching new records or at all-time highs too. How much has that factored into almost the appearance of a more robust economy than there might actually be? Like, I feel like folks sense that something doesn't feel right to them.
Yeah, that's a great point. So when the market tanked after Liberation Day, you had a wealth effect at the high end, and so people were high end consumers pulled back, but they're back with the vengeance. So I think it's not an equal economy for all households, and when you focus on that, then you can see the nuances of the economy. So what led me into this was a very close eye that I keep on the dollar stores. So the dollar stores went through real stress at the end of 22 and through 23. And I thought the dollar stores had bottomed, and we actually got a very positive on the dollar stores in November. I've since gone gone, more even, not as bullish, more even appealed with the dollar stores, simply because I think their consumers are going to be vulnerable. Their average consumer makes between 40 and 60,000, and that if you correlate what jobs are in hospitality and leisure, those incomes around 40 to 60,000. So I think the dollar stores, which had been seen as a flight to downsizing and not downsizing, but a more cautious consumer would go to the dollar store. I don't think that's the case. I think the actual core dollar store consumer is going to be stressed. And I think and so those will be ones I watch.
That's a real telltale sign too. If the dollar store consumer, we're not even talking about the Walmart consumer, you're talking about like the dollar store consumer, if they are stressed too, I mean, it makes you kind of wonder, like, what's the next rung down from a dollar store? That's a really, I mean, you're probably already struggling at that point. If the dollar store is kind of where you've already like gone down to from a consumer perspective, I imagine.
Well, that's what you saw after COVID ran out. The dollar stores really struggled. And I think the dollar stores, I mean, look, they've come down a lot in terms of from 22 levels. But I just don't think there's a lot of upside left in them. That they've run since November. They've run over 50%. So I just thought take your wins and move on. Now Walmart impacts 90% of consumers. I think Walmart is just such an incredible shopping experience.
Yeah.
And people aren't trading down to Walmart. Walmart's a phenomenal shopping experience and the delivery is incredible. So you drive to Walmart, you walk to the dollar stores. And so dollar stores are really when you don't have a lot of other options.
Yeah. I think it's, when I was a reporter, I covered Walmart. 90% of the US population lives, I want to say, within 10 miles of a Walmart, or 10 to 20 miles of a Walmart. And you're right. It is, I think it's the most popular grocery store too.
Well, so when I do mystery shopping between the dollar stores and Walmart has, in many cases, better prices than the dollar store, obviously a better array of goods. And the shopping experience is incredible. They're like, it meets every consumer where they want to be, whether it's organic. This is not an advertisement for Walmart, but I'm just pretty in awe of the consumer experience.
But it's a pretty interesting observation too, because I think one of the narratives out there is like, oh, people are trading down to Walmart, but maybe that's not the case.
I don't think that's the case.
Yeah.
I think that, I don't think that's the case.
Yeah. Okay. I do want to bring this up just because we did touch on the recession topic. We like to follow the prediction markets here. We follow our friends at Kalshi. I'm looking at the prediction market specifically for a recession, and it is right now at a 26% chance. So a 26% probability of a recession this year. That is way down from the start of May. It was north of 69% chance. So just like the general kind of sense.
I just want to be clear. I don't think you have a broad recession. I think you have a segmented recession at the lower end. And that's Main Street. That's Main Street who elected this administration, and it's sad. So the other area that I'm looking at is housing, which I don't think housing has. Housing is set to have its worst year in 25 in terms of overall housing activity.
Yeah, there's a lot of appetite on this channel too for analysis on housing. So that's one of the topics I would love to bring up with you because, gosh, you would think like normally the spring season is kind of like the buying season. From what I've heard from guests, it's been just absolutely awful and maybe worse than people realize. Can you kind of frame up your views on what's going on in housing? What are you paying attention to? What are you seeing? What's more of your outlook?
Sure. So April was the worst month since 2009, and May didn't look that much better. So you're bumping along. These are for existing home sales, bumping right along 4 million annualized home sales, and that is consistent with last year and the year before. I think it's going to be below that actually this year, and the estimates were close to 5 million in terms of what people expected going into this year. But obviously, there's a tremendous amount of uncertainty. But I think that there's a real core issue at the root of why there's not more housing activity, and that's because seniors own over 60% of existing homes, and they're choosing to age in place. And importantly, and then that's obviously a massive part of the housing market. So they're aging in place. A lot of the reason is because they can't afford to move. So they can't afford to move into assisted living. So the Joint Center for Harvard on Housing estimates that only 1 in 10 seniors can afford assisted living. So they're aging in place, and they're increasingly taking out home equity loans, tapping into the massive amount of equity that's been built up in their home to be able to afford necessary renovations to age safely in place, to have additional spending money to deal with rising homeowners insurance, property taxes, and just general living expenses. So today, seniors have 44% of the total home equity outstanding, which is a little counterintuitive. But what it means then is if seniors are tapping into the equity in their homes, that means though there's less pressure for them to sell their homes. And so you have a housing market that's stuck.
That's an interesting observation too, like that, like why the dynamics, like why they're stuck. And just like maybe on the senior side of things, aging in place, that's really interesting. You talk about like how expensive assisted living is. I can say anecdotally, there's an assisted living, it's within a community down here that's like a senior community, but they have an assisted living later on. And kind of the chatter in that community from what I've heard from visiting is that it's like a 10 to 15 or 20 year wait to get on the wait list to get into the, like, I guess like more of like the, when it's like full on, like almost like a nursing home situation too. So I guess it's like, maybe there's a lot of demand too, but I don't know. I thought that was interesting, like how long the wait list was, but aging in place, that's an interesting dynamic I'd not thought of. How about, what do you think this means for the first time home buyer out there? I want to buy a home, but I'm also at the same time, I'm trying to be patient because I'm not an expert, and I like to jog in the morning. So I see more homes being listed that aren't moving as fast as they had been maybe 3 years ago. So I don't know. I'm probably in that avocado toast generation for sure, but I'm trying to be patient. But what do you think this means for us out there? Like the ones that want to be first time home buyers.
Well, I think that you've got two things going against you, right? Where you have high rates and high prices. And usually when rates go up, prices go down. When rates go down, prices go up. But what's unaffordable is the combination, the double whammy of high rates and high prices. And so I think that there's another factor too, which is because so many homeowners have no mortgage, right? And after deductions, they sell their home, they're going to pay a big tax on that. So it's almost like what they have left over, they can't use to buy something that they want. So there are things that can happen in terms of bringing more supply in the market, in terms of the tax strategy policy to ignite more homes on the market. There, if you look at homes per household, it has been right around, it's 1.11 today. And it's been sort of like right around that level as far back as history goes, or as the data goes. So you have homes where people don't necessarily want to live that are available, and then homes where people want to live just aren't available. So it's a question of where people have migrated and where they want to live. So there's things that can be done, but I would say definitely be patient, because the combination of high rates and high prices doesn't bode well for long-term gains in the housing market.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold, paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: Why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Do you think are we in a bubble as it relates to like the housing market, or like how do you kind of I'm trying to think, maybe diagnose it. Like I'm trying to like wrap my head around it. Like, is it a bubble? Is it not a bubble? I don't really know how to like think about it, but
Well, until you have more supply on the market, you're in a very gummed up situation, right? So is it a bubble? Look, in Florida and Texas, you're starting to see weakness in the housing market because there was so much building, excess building. And then it's all, real estate, of course, is all regional. So it depends on where you are. There's no bubble like there was in 2006, 2007. It's not like that. But look, you've had broad-based inflation. You had zero percent interest rates, and asset prices went up dramatically.
Do you think the prices eventually come down?
It all depends on supply.
Yeah. There's that dynamic that you point out, the demographic dynamic too. Huh. Interesting. Well, I will definitely be watching that. Okay, I want to move on to this concept of the avocado toast generation. Can you frame that up for me? I want to hear more on that.
Sure. So it's the 24 to 38. The dynamic is they don't own homes. They have more discretionary income because it's cheaper to rent than to buy. In many cases, they're still living with their parents. So 1 in 5, 20% of men in this cohort live at home with their parents. So they're not paying rent. They have more discretionary income. They're either online gaming, online sports betting, dining out. You see spending, and a really good perspective to look at this specifically is with American Express. So American Express has targeted this demographic because they have such high spending patterns. And American Express doesn't make money lending. They make more money by the swipe, by how much people spend. So they've really, they call it the Gen Z and millennials. I call it the avocado toasters, because people over 40, more often than not, they'll be homeowners. Under 38 to 24, I would say disproportionately, they're not homeowners. So they are very interested in experiential spending, travel, as I said, dining out, going to concerts. So they're a high spending cohort. I think that's a interesting cohort to watch in terms of, and I look to American Express because they segregate out this cohort in terms of how they'll feel with rising prices and a weakening job market.
Yeah. I think you nailed it too. I'm 37, and I feel like maybe my generation, we definitely eat out more. You're right about the concerts. I almost feel like it's also like a bit of an Instagram generation too, of like you see your friends like traveling in Europe or something. I feel like we take a lot more vacations, and yeah, you're definitely right on the experiential, but we probably wouldn't if we had homes. We probably wouldn't be spending like that. We would be paying our mortgage.
Well, that's the issue, right? You have more discretion. It's a chicken and egg. You have more discretionary income because you don't own a home. Owning a home has been incredibly expensive over the last 3 years. You've had, over the last 5 years, homeowners insurance gone up 70%.
Mm-hmm. And my friends who own homes complain about that. Yeah. Especially,
well, particularly in Florida, right?
That's exactly. Boca Raton was where one of my friends was talking about it. Yeah.
And if you can get insurance, right? If you have a mortgage, you're required to have homeowners insurance. And in many cases in Florida, it's really difficult to get that. And it's incredibly expensive. So the bankers refer to people who move to Florida because they think, I'll retire, no taxes, it'll be a great standard of living. And then they all of a sudden realize it's actually very expensive to live there because homeowners insurance is so expensive. So they move halfway back because they're called halfbacks. So they'll move to South Carolina or Tennessee.
I didn't buy a house, but I lived in Florida. I moved to North Carolina, New York, Miami, North Carolina.
Yep, you're a halfback.
Yeah. It does make me wonder too, like that segment, maybe it's a little bit distorted too, of like, I don't think we feel like great about our circumstances or anything, but probably has given the illusion that maybe the consumer's stronger. I don't know. I don't know. It feels like a little bit like it's an illusion, like the strong. Maybe we don't feel strong as consumers, but we are spending.
The spending from the avocado toasters has been as high as 7-1 versus baby boomers.
Wow. Yeah.
It's stunning.
Yeah. Interesting. Wow. Okay. Another topic I want to bring up with you is our nation's fiscal picture, because the last time you and I spoke, I want to say our debt was just over 34 trillion. It's now over 37 trillion. And the reason I bring up the fiscal picture with you too is you wrote a book in 2013, Fate of States, really looking at their fiscal picture too. So that's why I feel like you might have a point of view or analysis. How do you think about the fiscal picture here in the US and maybe more of your outlook?
Well, what was so interesting about the states is that 49 states are required to have balanced budgets. So Vermont is the only state that doesn't have to is not required to have a balanced budget. They do anyway. But so something's got to give with the state. So what is constitutionally guaranteed are pensions and municipal bonds. What's not constitutionally guaranteed, education, public safety, safe roads, all the things that you think your tax dollars are going towards, but that's effectively discretionary. So when those services decline, people with means can move and do, and then people without means are left with lower social services and then a lower tax base because people with means have the majority of taxpayers have left. So that was something that you could really get your hands around, although it was incredibly difficult to wrangle the data. And time with the federal deficit, there's no such thing as a requirement to balance the budget. If there were laws that required it, we could have enacted those back in 2000 when there was a balanced budget. But we're so far beyond that. I think what's difficult today is the fact that you've got this mounting debt and you've got fewer buyers of the debt from an international perspective. So we've made ourselves vulnerable because 40% of the debt is owned by foreigners. So I think a big push to the stablecoin is because stablecoin will have to be rooted in Treasury. So the government is looking for buyers of treasuries, and perhaps the reason why they're pushing stablecoins so much is because that's an obvious market. Who knows how big that is. They've also pushed the banks, or they've lowered the supplementary leverage ratio for the banks to entice the banks to hold more treasuries. I'm not convinced that the banks want to load up on treasuries. So, you're just in a unfortunately, the U.S. has put itself in a situation where they've got to search for buyers, right? You issue more debt, you need buyers to keep rates down. So I don't know that rates. This is getting back to affordability. It's hard to imagine that rates go down. The long end of rates go down. Go down meaningfully. I hope I'm wrong, but I really, from what I'm looking at, I don't see the long end going down very much.
Yeah. Okay. So when you talk about the rates not going down on the long end, can you explain what the implications of that would be? Because it sounds like people just don't want to be on the long end of the Treasury curve. From what I'm hearing from other guests, I had guests say they don't want any long dated government-backed treasuries. What would be the implications?
If your guests don't want it, why would you think that banks would want it?
Exactly, but would they be forced to have it, or kind of
well, you
pressured?
Can't force banks to do anything. They're at the they serve at the pleasure of their shareholders, right? So they have to do what's best for their shareholders. And in many cases, the banks have return thresholds that buying the long end of treasuries is not going to make their return. And then they have they could be guaranteed interest rate risk, or they wouldn't have to mark to market, but still, I think it's too risky for the banks. So what it means is if the long end continues to go up, the cost to borrow for anything long dated just gets much more expensive. But think if I always like to fashion it towards kitchen table economics. The more debt you have, the riskier you are, and the higher your cost of borrow is going to be. I mean, think about it. If you were loaded up on credit card debt, auto debt, personal loan, anyone underwriting you would say, Julia, okay, I'm sorry, we're going to have to charge you a lot more because you're already swimming in debt.
How about the Fed? Are they just in a tricky spot? Are they cornered? Like, what are their options? Can they do anything here?
Well, they own, they're a large owner of treasuries. They're unwinding their mortgage-backed security holding. I think the Fed is in a really impossible situation because you're going to have a weakened economy with inflation, with a weakened labor market. So that's stagflation, and that's a really tricky thing to navigate.
Yeah, stagflation has historically been like the worst environment for pretty much all asset classes too. Do you think we'll see cuts this year?
I think the summer is critical. So, they are, surely the regional Fed governors have Fed presidents talk to the companies, the CEOs in their districts, and they bring that feedback back to Washington. But the hard data isn't giving them any real indication one way or the other, and I think that's why they're on pause. So maybe September would at the earliest. Maybe 2 rate cuts. I don't see anything in July.
Yeah, I'm looking at the prediction markets and the forecast is for 2 rate cuts. Yeah, but I don't know. Let me just see like what the July forecast is, or at least looking at the Fed decision in July. Yeah, most folks are expecting like 81% see the Fed just maintaining. So yeah, that's also.
Well, I mean, again, the hard data has not been. I mean, today's data started to look like how people feel. So there's the sentiment, like there's the on the street sentiment, which feels a lot weaker than the numbers have come in. When the numbers start to reflect how people, everyday people feel, then the Fed will have more of a incentive to act.
Yeah. Yeah. Before I let you go, let me ask you some parting questions here. You are someone who is so great at looking at the data, unearthing like what's going on. You have been a lone voice in the past, and you've been a lone voice and a right voice too, especially during the global financial crisis. What is the thing that you're looking at today? Maybe that risk out there that's underappreciated, that's keeping you up at night?
Well, I look at something. So I have a very keen focus on home equity right now that I don't think that other people are looking at, and I think that's that you're going to have a home equity renaissance, I think, over the next few years. And so, home equity had contracted for the last 17 years, and the fact that it's expanding now is, I think, a get out of jail card for a lot of consumers, at homeowners. The big one, the big risk is that I see that everybody sees is the Treasury market, right? So all the things that you mentioned in terms of our fiscal, our real fiscal challenge, and that nobody seems to want to deal with. The government keeps spending. So those are the things, because if you have rates spike up, obviously it makes the market look, really overpriced. So I would say the Treasury market, but I'm not unique in that. I think I always look at things differently than other people, but there's no different way to look at the risks in the Treasury market.
Yeah. Yeah. Okay. Wait, okay, before I let you go, can you explain the home equity as a get out of jail free card? Can you put some more meat on the bones there? Because I mean, I'm not a homeowner, so I don't even know the mechanics of this, but explain the significance of it.
So let me explain. So there is over 35 trillion in equity in homes. We estimate that there's $26 trillion of tappable home equity. That means your loan to value stays below 80%, which is considered safe, and you can tap. That's 26 trillion. That's incredible. The size of the home equity market today is right around 500 billion. So there's a massive amount of untapped, or untapped equity that the household can access. So that means that, and I think what you've seen is people are increasingly accessing it, paying down credit card debt because it's the cheapest way to borrow money, and they're able to sustain themselves in ways that otherwise they wouldn't be able to. So it's I think it's for consumers. I think the government, that would be a big sign of relief for the government that the economy could stay afloat a lot longer.
Wow, that's
because of this
fascinating.
liquidity.
Yeah. Huh. That's really interesting. I love how you like unearth this data that I haven't heard anybody else talk about that. So that's I had not even heard of that, but that's really interesting. And that's like the get out of jail free card right now. Okay. Meredith, this has been awesome. You are so fantastic. I love having you on. I want to get you on more often. Before I let you go though, let folks know how they can find and support your work. I know you have a retail subscription offering as well. And any parting thoughts, anything that you'd like to leave this audience to think about, the floor is all yours.
That's a tough one. Well, my website is meredithwhitneyllc.com. I do have a retail offer that I give institutional research at a retail rate, but I also have a lot of institutional clients. And I just be curious. I just, I love what I do, and it's so fun. So parting thoughts, just read as much as you possibly can and keep asking questions.
I love it. Meredith Whitney, CEO of Meredith Whitney Advisory Group. It has been an absolute treat having you back on. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us learn and get better and, see these things that we're frankly not hearing in other channels. So really, really appreciate you. And I look forward to our next conversation. Until then, be well. And thanks again, Meredith.
Thanks so much, Julia.